morning, another quick update. I was checking the 10-year Gilt, and it's actually really at very dangerous levels. Although we have this one-day term structure risk premia compression, there is no way anyone should be complacent. You see the MACD here, it's just here, and we are at the bottom of the downdrift, which there is a clear divergence between the direction of the yield going up and the MACD going doing a downward direction, downward curve. So the yield and the indicator, they show a divergence. The moment this starts to go up again, and we have the cross between the cyclical and the signal line, then it means that the yield is going to go up again, over and over again. And there is no way to be complacent, because the 10-year Gilt, it's going to approach the 6% level here. Not 3, not 4, not 5, but 6%. Because this Fibonacci level is 5.98. So there are the clear prospect of a Gilt market crisis flaring up in summer, in the next 3 or 4 months. I think there's going to be, or as far as what is the winter budget, I think I'm quite sure that for what are the current fiscal policy stances of the government, but frankly of any government, there is no sustainability in the fiscal position for the UK as for any other country, maybe Australia, or even, I don't know, any country in Europe. Very few are virtuous, but the UK has this idiosyncratic structural feature, which is Brexit. It makes everything much worse. There are no prospects of any significant private investment taking the adventure or the risk of creating work or jobs or any sort of business in the UK, because it is not worth it. The cost of business, as repeated over and over again by the same British businesses, is too high. It has become very, very high because of taxation, because of the obnoxious bureaucracy, and the constant ostracizing of businesses because of the Brexit decision. So all the trade barriers, the bureaucracy barriers, the paperwork barriers is an obstacle to capital flows, to goods and services, to the easiness of having a smooth business activity which can access a wider European market without any sort of costly paperwork and all sorts of ostracizing impediment. So the structural barrier of that the UK has imposed with Brexit, has demanded with Brexit, and the structural inflationary nature of the UK economy, they will basically, they are materializing in the natural outcome that the risk of the yield curve, it has to be priced higher and higher and higher, especially when we have this large global supply chain shock, large inflationary shock, which are going to persist. And so technically, when there is a volatility shock in any financial asset, which in this case it's the chart of the yield priced into the market, this volatility shock is going to persist. It becomes an information, becomes a market information for the bond investors, which see that the yield is going higher and higher and higher. And so the market is basically net selling outright UK government bonds, because they see that the fiscal situation is unsustainable, and that the wider economy, it basically there are no prospects for solid economic growth or for a wider period of investment, basically because of global geopolitical uncertainty, and even worse because this Brexit barrier that the UK pretends to have. And on the financial risk side, the UK bond market being outside the euro area financial market liquidity also pays an high price of risk premium. So there is no way that anyone should be complacent for today risk premium compression, because the 10-year, it's what is now, it's 4.7, 4.6 something, I don't mind, but I see the clear risk of a gilt market shock coming within the next 3 to 6 months, and the 10-year gilt going to 6%, because the bond market is going to melt down because of so many other reasons, like the leverage that is in the bond market and the lack of credibility of any UK government since basically 2016. Because the whole uncertainty for any sorts of interlocution with the political circles in the UK, it puts off any sorts of private sector investment. And when you have governments that want to expand more and more borrowing to invest, and so they are crowding out private investment, and taxation, it's increased unemployment, then you have the final straw that breaks the back of the camel, and the risk of a higher yield curve path going higher and higher and higher, because the fiscal position is unsustainable with all these macroeconomic variables and the obnoxious idiocy of Brexit, then the UK will tip over the balance for sure. The bond market is going to teach a very good lesson to Brexiters.